All right, so with sampling, you want to test transactions and things, but you don't want to test every one of them because that would take forever and would be impossible in some cases. So you are looking to select some portion of the population that should be representative of the entire population. It's a sample, right? So like if I randomly took 10 of y'all's test grades from exam 2, it should theoretically represent about the 75% overall average, right? If I did it right. So that's what we're looking for. There's two general approaches to sampling, to choosing your sample size and choosing things that are sampled, and they're both generally accepted. Non-statistical sampling is just not determining your samples mathematically. You're just kind of purely using judgment to figure all this out. And then statistical sampling has, benefits of, you're setting up all this mathematical calculations based on sampling risk that you're willing to accept. It's a very quantitative approach. This still requires judgment and figuring out the parameters that goes into, the math thing that you're kind
of. That would be like materiality
cranking out. Yeah, all that mess would be in there. Yeah, all this stuff would be in there mathematically. And then you'd have, a more objective, a more defensible, if you needed to defend it, sampling procedure. But it still involves judgment. So don't let a question trick you into thinking there's not judgment involved in statistical sampling. There certainly is. But yeah, regardless, either way, hopefully you'll end up with a sample that is truly representative of the population. All this stuff about sampling risk. So sampling risk is a definition that your sample that you ended up with is not representative of the population. So that can cause problems. It can cause two types of problems. And all this is fairly important. So the errors that can occur because your sample is not good, there are two types. There's a type 1 error, which is a false rejection, which is saying I rejected this, but I shouldn't have. I said it was bad, but it was actually fine. All right. That's one thing that could happen because your sample is not good, right? So and we can do samples for testing internal controls. We can do samples for testing details of balances and things like that, substantive tests. So if you are doing a sample for controls, you're saying, I didn't think I could rely on these controls, but in reality, I really could have. If I had not done this sample and I just tested everything in the population, I would have come to a different conclusion. And with this type of error, you think they're bad, but they're really good. With the controls, you think you could have not relied on them, but you really could have. With substantive testing, you think the number's bad, but it's really a good number, right? So a good thing to keep in mind is if you make this kind of error, it's not the end of the world. It's just an efficiency problem. You're going to end up doing a bunch more tests, but hopefully you'll come to the correct conclusion. You just have to work a lot harder for it. So you got a screwed up sample that gives you this type of error. You think it's bad, but it's really good. You're just going to beef up your testing and hopefully come to the right conclusion at the end. Efficiency issue. You will probably achieve the appropriate conclusions, just not in a very efficient way. All right, not as serious as this next one. Type 2 error is I didn't reject it, but I should have. It was bad, but I said it was good. The controls were no good, but I relied on them when I shouldn't have. The number was really a bad number, but I said it was a good number. All right. So this is not an efficiency issue. This is an effectiveness of your audit issue. Your audit is no good, right? So you may not meet your overall audit objective if you make this type of error. So that's important stuff. Takes a little bit of running it through your head to figure it out in test questions and things, but it's doable, right? False rejection, false acceptance. All right. Very good. So that's all sampling risk. There's also non-sampling risk, which is a catch-all for any other mistake an auditor could make other than sampling risk. Seems like a weird definition and a weird thing to call that kind of risk. Non-sampling risk, you know, bad auditing procedures, failure to identify errors, misinterpreting the results. All of those are non-sampling risk. It's kind of stupid, and it makes those test questions kind of be like, that's weird. But yeah, take note of that. It's a non-sampling risk. I'm not sure who decided to categorize them as one or the other, but they did. And then you've got attributes and variable sampling, which actually have their own sections coming up. So we'll touch on those as they come up. But attribute sampling is sampling for the purpose of testing of controls. Variable sampling is sampling for the purpose of making sure the dollar amount of your account balances are fairly stated. So attribute sampling is test of controls. Variable sampling is substantive test. We got separate sections on both of those coming up. So let's see about these questions here. All right. Look at number 1. Which of the following is a sampling risk that's associated with the efficiency of an audit? All right, so we just said the efficiency of an audit, that's that type 1 error, which is where we are saying that it's bad, but it was really good, right? So another way of saying that as far as control risk goes is we've assessed control risk as too high, higher than it should have been. So that kind of language comes up in some of the test questions too regarding this type of error. I said it was bad, but it was okay. I said control risk is high. It was really shouldn't have been as high as I thought it was. I am under relying on controls is another thing to kind of keep in mind. They can use any different ways of saying the same thing, and they often do use all these different ways of saying the same thing. So assessing control risk too high. Under relying on. It's not a word. Is it just one R? I guess we'll hyphenate it. Under relying on. Seems like that should be a word, doesn't it?
I agree.
Oh well.
Maybe word is wrong. Maybe word is wrong.
Yeah.
Word is wrong, definitely. That's wrong. So all, maybe put these in a list, type 1 error, false rejection, control risk too high, under relying on control, they all kind of mean the same thing. So back to our question here. Which of the following is a sample risk that's associated with the efficiency of an audit? The risk of assessing control risk too high. It's not incorrect acceptance. That's the type 2 error. This is incorrect rejection. And then C and D are throwaways. But there you go. Does that make sense? Okay. How about number 2? When performing a substantive test of a random sample of cash disbursements, an auditor is supplied with a photocopy of vendor invoices, supporting the disbursements for one particular vendor rather than the original invoices. The auditor is told that the vendor's original invoices have been misplaced. What should the auditor do in response to this situation? This is more of a question that could have gone anywhere and not necessarily in this section of the book, but we've got a deal where this kind of raised some red flags and given us, it's kind of caught our attention. So we would reevaluate and try to figure out some other way to get at it, right? So that's not so much about sampling as it is other things. But back to sampling with number 3. Here's that whole sampling versus non-sampling risk. Which of the following statements about auditing sampling risks is correct? B says non-sampling risk can arise because an auditor failed to recognize misstatements. So yeah, if it's a risk other than because of sampling, it is a non-sampling risk, right? A wouldn't work because A says non-sampling risk arises when substantive test is restricted to a sample. Conclusions might be different had we tested everything. That is sampling risk, right? So just kind of highlighting the whole know the difference between sampling versus non-sampling risk, weird as it may be. 6. While performing a test of details during an audit, an auditor determined that the sample results supported the conclusion that the recorded account balance was materially misstated. It was, in fact, not materially misstated. I don't think this was the one I was planning to look at. No, it was. I'm sorry. This situation illustrates the risk of what? All right, so sorry, I was thinking I was looking at a question I didn't mean to look at, but I did mean to look at this one. Now I remember why. So let's look at it again. Performing a test of details during an audit. Test of details of balances, that's a substantive test, right? That's testing dollar amounts. So we can throw out A and we can throw out B because of that. Assessing control risk too high or too low would be if we were doing a test of controls. So we're down to C or D on this. So that one makes that one a lot easier, right? So in this one, we said it was bad, but it really wasn't. So we incorrectly rejected it when we should not have. That makes this one pretty easy, right? 8 is one of those, be careful. Wait. Yeah, wait. I don't know. I keep being afraid I'm choosing the one I didn't mean to choose. Yeah, this is the one. Sorry. An advantage that using statistical sampling methods over non-statistical methods in test of controls is that statistical methods, from the literature I've read, it seems like they're saying that the test people are trying to trick you into answering B on this. They feel like test takers feel like the statistical method, since you're just number crunching and cranking out all this mathematical stuff, is that you don't need to use judgment in determining sample sizes. So I marked this one just to mention that. So don't be tricked into answering B. I don't feel like any of us would be tricked into that though. But it doesn't eliminate judgment. We still have to apply judgment to get the inputs into this mathematical thing we're spitting out. But it does give us a more objective basis for quantifying all this stuff. So D is a good answer for that. All right, that's our introduction to sampling. Any of these others you want to look at? Oh, did I mention about the, oh, sorry. So it's what we said, with the lien on the insurance policy that we were talking about. It said that it's possible that the lien holder required to be listed as the beneficiary and could somehow have the original copy of the thing. I don't know. No, absolutely not. No, that's just a weird question.
Yeah, because if it was in like the name of the company,
Mhm.
if they wanted to, they could take the money and pay back the loan.
Yeah, I guess. I don't know.
Oh.
Does that question belong in that section? Or belong?
That was in the
Or
fixed.
belong?
That was in the fixed assets section, wasn't it? I don't know where that one would belong. I mean, it could be a question, but it's just one of those that there's no way to study for such a question like that. And
Okay, so I just need the experience.
I wouldn't fret over it. Nobody's going, well, somebody probably got on there and made 100 or 99, I think is the highest you can make with their scoring on the CPA exam. But, you're going to miss some. That'd be a good one to miss. Because how do you study for something like that? It's weird. It's not something you would see in any of the study materials at all. Nobody's written a little section about insurance not being in the name and all that. And the little author note about it was, it's entirely possible that this could happen. It's not unusual to not be able to find the original insurance documents anyway, because so-and-so companies tend to be unorganized when it comes to, that kind of, it is a stupid question.
So it was an awesome question.
I forgot to look, but it probably was. I don't know. I should have looked. I forgot. But yeah.
Author voice.
Huh?
Author voice.
Is that my author voice? I guess it is.
But now, if we do see that one, we ought to get it.
Oh yeah. I would bet a whole lot that you would not get that question though. But it'd be great if you did, because we would all get it. Attributes sampling. So this is the one for testing controls. So you're not talking dollar figures here. You're talking a test of controls. You're talking, you're grabbing a sample and you're looking at whether your sample of whatever you're looking at, you're looking for a percentage frequency that something went wrong in this test. You're trying to figure out if internal controls are working as designed. And again, tests of controls are being done so you can eventually determine the nature, timing, and extent of your substantive test, right? So you're testing controls. You want to see if this control works. You're not going to look at everything that went through this particular test or whatever. Maybe you're testing whether something was properly authorized. You're not going to look at every single thing that needed to be authorized. You might grab 50 of them and look at them, or 10 or 15 or 20 of them and look at them and say, all right, all 20 of those were good. This control is working. Let's move along. And, it all is being done so you can figure out what your substantive procedures are going to look like as far as the nature, timing, and extent of it. So sampling, you're usually talking about yes and no questions. Did it work? Did it not work? Right? And you're trying to figure out the percentage of the ones that didn't work the way the control was designed. So there are ways to determine sampling methods. There are statistical sampling approaches, random numbers where everything has the same probability of being selected, systematic where you just select every 100th item in the list. We did a lot of that in our audits. We would get the population. We would have all of our materiality levels to figure out this, that, and the other, how many we wanted to sample. We would randomly choose one of them, and then, after we had divided the sample by however many we wanted, we would just start at that random starting point and catch every, 20th or 30th one or whatever. We would do a lot of that. So that's systematic sampling. Judgmental sampling approaches, there's a block method where you just grab a big group, like everything that happened in June. That's obviously not a good way to do it. Haphazard is just arbitrary selection with no conscious biases, but there could be subconscious biases. So judgmental sampling approaches are just not a good way to do it.
I always say haphazard.
Huh?
Just some kind of curiosity now. We always say haphazard. Why is it not haphazard?
Haphazard?
Yeah, because it's the pH.
Oh, haphazard.
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 That's something I didn't realize.
Huh. Haphazard.
Haphazard. Because I always say
How
haphazard.
do you say it?
Haphazard.
Haphazard?
Haphazard.
I don't know how I say it.
I just saw that word and had never seen it
Caleb.
before.
I would have. It would have.
You are just so like angry.
What did you say he was?
A dog.
A dog? Haphazard. I've never considered calling it haphazard. That would never enter my mind. Haphazard. But now it will every time I see it. Haphazard.
Yeah. Why is it not haphazard? Because it's a PH. Should be.
Well, it would be haphazard. It's haphazard.
Haphazard.
How do you say it? Anyway, I'm sorry. I'm trying to go on. It's just one of those things that
Oh man. All right. So here's where it gets a little bit harder to deal with in this stuff. So let's see if we can make the best sense of it. So determining sample size, they say you'll consider these three things: tolerable deviation rate, allowable risk of assessing control risk too low. Again, we're doing just test of controls here with this. This is attribute sampling. The good thing about all this we're about to do, everything we're about to say really carries on in conceptually into variable sampling too. So we don't have to revisit again so much. Different terms for it, but it's really the same general idea. So the thing that you need to know is, as these go up, as these go down, what does that do to your sample size? That's good stuff to know. So tolerable deviation rate. All right. There's a definition that I stuck out there in case you need an actual definition to look at, but it explains itself, right? Tolerable deviation rate. What deviation do you tolerate, right? Fancier definition is the maximum rate of deviation from which a procedure the auditor will tolerate without changing their planned reliance on internal control. So there's a longer fancy definition in case you need it, but in real words, it's just what will we tolerate? What deviation are we okay with? So as I'm skipping down here for a second. As the tolerable deviation rate goes up. Well, hang on, let me preface all of this junk that we're about to look at with this. Variability and uncertainty. That's kind of what we're looking at here with all this. Variability and uncertainty. As that goes up, as we have more variability, as we have more uncertainty, that will all lead to a larger sample size. So tolerable deviation, as that goes up, the sample size goes down, right? As we are tolerating more and more a bigger deviation, as we decide we're okay to tolerate a bigger deviation, we're okay with a smaller sample size, right? That makes sense. You know, I want to make sure no more than 5% of these was done incorrectly. If I want to make sure no more than 10% of these was done incorrectly, sample size can go down, right? And then vice versa on all these. As tolerable deviation goes down, sample size goes up. All right, makes sense? All right, allowable risk of assessing control risk too low. That's a mouthful, right? So bouncing back up here. Oops. We said this type of error is the one that we really don't want to make, right? Assessing control risk too low. We do that, we are saying we accept something that we shouldn't, and it leads to a bad audit, right? You know, type 1 just leads to an inefficient audit. This leads to a bad audit. So that's the one we really want to focus on here. So assess allowable risk of assessing control risk too low. So I put a bunch of different words for the same thing here. As the acceptable risk of assessing control risk too low goes up, the sample size goes down. Another way to say that is as over-reliance goes up, as false acceptance goes up, as type 2 error goes up, blah, blah, blah. Sample size goes down. So if I'm allowing for more risk, if I'm more accepting of the risk of over-relying on controls, that'll result in me being more okay with a smaller sample size, if that makes sense. It's a weird sentence. As the acceptable risk of assessing control risk too low goes up, the sample size goes down. So you kind of have to put that into your own words to make it make sense, right? So as I become more accepting of the risk of relying on a bad control, I'm okay with a smaller sample size. And then as expected deviation or expected error, I'm not dividing here. Looks like a division, doesn't it?
Slash.
Slash
Yeah, the expected deviation slash error rate is up.
makes it look like I'm dividing. Somebody look at that one. Why are you dividing? Yeah, this is better. As the expected deviation rate goes up, sample size goes up. And that makes sense, right? The more I expect to be screwy, the more I'm going to sample to gather better evidence to see if everything's okay or not. So as the error rate goes up, sample size goes up. So as variability goes up, as uncertainty goes up, sample size goes up. Good stuff to know. Population really doesn't have an effect so much. So as the population of your, as the whole population size goes up, your sample size might go up, but there's really not a whole lot of effect on your sample size. Depending, if this population is huge and this population is half of that, your sample size, it doesn't really affect your sample size so much. So that's not as big a deal. So there you go. All good stuff to know, a little bit difficult. And here's where I felt like they just got kind of really confusing. So here's what's happening in a nutshell with the whole sampling process. Test the controls. All right, so we're figuring out first we want to figure out what we're trying to figure out, right? Maybe I want to see if things were properly authorized. Maybe they have a rule where things above $10,000 purchase orders are supposed to be authorized by somebody. I only want to test that control. So, that's kind of step one, is figure it out. What are you testing, right? Figure out your population. All right. My population is every single purchase order over $10,000. That's the population. I don't want to test every one of those. I want to sample those, right? So now I need to figure out my sample size, and that depends on all these things, materiality levels and things like that. Depends on your deviation rate, how many you expect to be wrong, your tolerable rate, the most that you're willing to accept without changing what your original reliance was on it, and the risk you're willing to accept for screwing it up with your sample, right? Over-relying on, under-relying, over-relying on, get mixed up too. Assessing control risk too low, over-relying on controls. All right, so you get your sample size, then you select your sample. Random is the most common. That systematic thing that I said we did is acceptable. Block is not really acceptable. You select your sample some way. And then you see how everything went. Here we're seeing if things were authorized or not. Yes, yes, yes. No, yes, yes, yes. And then you calculate the deviation rate in your sample. What percentage of these that I sampled were wrong? 95% of them were right, 5% of them were wrong. That would be my sample deviation rate, 5%. So then I'd kind of project that out to the entire population and kind of get an idea of what I think the entire population is screwed up by. And then I decide if I'm okay with it or not. That's really in a nutshell what we're doing. Now there's these tables, and this is what we don't have to do, I don't think, on the CPA exam. There's these tables that you can use to calculate all this stuff. You come up with, now conceptually we need to know this stuff, but you come up with what's called an upper deviation rate or a maximum deviation rate. We just projected our sample results to the entire population. Now we need to see if we're okay with it, right? So we're going to compare that to this upper deviation rate, this maximum worst case scenario. We're auditors, we're concerned with worst case scenarios. We want to see if we're okay with the misstatement that we just calculated versus what we set as our upper deviation rate. So, let's see. I think our book called it an achieved upper precision limit. It's a horrible way of saying that. That's what they're saying. That's a better way of saying it, upper deviation rate. So we'll take our sample error rate that we computed from observing what we saw in our sample. And then we're going to throw on a little cushion, an allowance for sampling risk, just to give us a little margin for things we might have missed. We're wanting worst case scenario here because we're conservative type people, we as auditors. So adding those together will give us this upper deviation rate. And then basically we'll compare that upper deviation rate to our tolerable deviation rate and see if that upper deviation rate is less than what we tolerate, we're good. If it's more than what we tolerate, we don't like it, we'll go from there, right? So that's in a nutshell what we're doing. I don't feel like the book did it as well as they could have. But the notes I took from the book were just these. I don't like a lot of this. So, you're making a decision according to their notes on whether you can rely on the effectiveness of the internal control that you're looking at. You'll calculate your deviation rate. They call it, they use all these long words that they don't need to use. Observed deviation sample error rate. Just our deviation rate. How many were screwed up compared to this total number we sampled? What percentage were wrong, right? And then they talk about this point estimate and all this. I think that's not that important.
Sounds like a bunch of this.
Yeah, that word, that's what we just said is blow it out to the whole population and see what it looks like, right? And then we're going to have this little confidence interval, but we're really not worried about the lower end of that confidence interval. We're only worried about the upper end of that confidence interval because we're worried about worst case scenarios, right? Calculating that, don't worry about doing that in the CPA exam. Just understand how to kind of deal with it all. And then once we have this, we compare it to our tolerable rate and see if we can rely on it or not. So that's the whole process there. Now let's look at some of these questions to see what types of things they might ask. These first are kind of easy. 3 is real easy. 2 is just, I think I made a special note about it because of this, but the number of items in the whole population would have the least effect on your sample size. What 3 things do we say had a big effect? Tolerable rate of deviation, degree of assurance desired, planned assessed level of control risk. Different ways of saying the 3 things that we said, but yeah. The number of items in the population would have the smallest effect on the sample size. Attribute sampling is for test of controls. So look for which of these is a test of controls instead of a substantive test. So that's another question they could ask. There's another one where the population size has little or no effect on the sample size. So they like that question. Another one listing out the different things that go into determining your sample size. And here's one of the harder ones, I guess. So number 7. I mean, it's really not when you look at your possible test answers, but let's look at it in full. An auditor desired to test credit approval on 10,000 sales invoices processed during the year. Designed a statistical sample that would provide 1% risk of assessing control risk too low. So that gives us 99% confidence. So they put a number with that assessing control risk too low. You know, this question could have taken a spin and said, what if they wanted 2% risk? You know, what would that do to your sample size? So they could go a lot of different ways with these questions. But with this one, they're just kind of building a story. That's where we're at on our control risk acceptance. The auditor estimated from previous experience that about 2.5% of the sales invoices lacked approval. So that would give us an idea of our expected deviation rate. We base that on the past, right? So we ended up sampling 200 invoices. 7 of those were not working the correct way, and the other 193 were fine. The auditor determined that their upper precision limit, their maximum, what did we call it, deviation rate, is 8%. So that's the upper end of that confidence interval. That's the worst case scenario, 8% thing. So this is all the stuff they have and all the stuff they figured out. So now they're evaluating this sample to see if the sample proves that everything's okay or if they have a problem with what it proved, right? So how are they going to do that? So in evaluating this sample, the auditor decided to increase the level of preliminary assessment of control risk because what would cause them to do this? All of this cranked out an upper precision limit, which we've been calling what's the word? Maximum upper deviation rate. Yeah, an upper deviation rate of 8%. So we're saying we're within the realm of possibility of there being an 8% problem here, given this little cushion we threw on top of what we observed. We're only tolerating 7, so we got a problem. We're tolerating 7. It's in the realm of possibility that there could be 8% of these off. We're outside of what we're willing to tolerate. So we're going to go from there and make some changes on our audit plan here. It's a good question and a typical type question. Tolerable rates less than the achieved upper precision limit. That's a problem. Make sense? A lot of words, a lot of things to straighten out, but that's the entire concept of this. You didn't even have to read this question at all to answer it. All you had to do is look at this, and that's the question and answer, right? None of this background story means anything, but it's kind of nice to see a real life example of they did this and they found this, you know, they assessed it at this and they looked at past experience and they got expected deviation rate of this. Kind of drives some of the points home a little bit. All right, look at number 8. Yeah, it looks like a math question, but it's really more of a conceptual question with some simple numbers thrown in the mix. An auditor decided to test credit approval on 10,000 sales invoices processed during the year. They designed a statistical sample that would provide 1% risk of assessing control risk too low, which would give them 99% confidence that not more than 7% of the sales invoices lacked approval. The auditor estimated from previous experience that about 3.5% of the sales invoices actually lacked approval. A sample of 200 invoices was examined, and 7 of them were actually lacking approval in their test this year. The auditor then determined that the achieved upper precision limit was 8%. If that's all the case, what was their allowance for sampling risk? So that all goes back to this little formula we highlighted a second ago. Sample error rate that we calculated, plus this allowance gives us that upper deviation rate. So the sample error rate or sample deviation rate, right? You don't get fooled by the interchangeable words that they keep using. The sample deviation rate, 7 of them, oops. Seven of the 200 were wrong, right? So 7 over 200 equals 3.5% sample deviation rate plus whatever sampling risk, that's what we're looking for, equals that 8%. So 3.5% plus what gives us 8%. So it's 4.5. So that just requires you to know how that upper deviation rate is computed. You got your actual sample deviation rate plus that cushion to give you that upper one. It's a real simple idea. But that's a really good question too. Number 9. All right, look at this mess. Diagram below depicts the auditor's estimated maximum deviation rate, upper deviation rate, compared with the tolerable rate. So that's what we do when we, at the end, where we decide if we're good or bad with the sample and what we found, right? As well as the true population deviation rate compared with the tolerable rate. So the things we gathered from our sample versus reality is what they're saying here, right? So this is leading us toward type 1 and type 2 errors being made, right? As a result of tested controls, the auditor assesses control risk higher than necessary and thereby increases substantive testing. This is illustrated by which of these situations? All right, don't you love this setup? So which of these intersections in this little grid would lead an auditor to assess control risk higher than they should have? So higher than reality, right? So the true state of the population would be that the deviation rate is less than the tolerable rate, right? So the true state of the population is everything is good. That would be the good thing. But we screwed up and thought that the maximum deviation rate was more than the tolerable rate. That would cause us to assess control risk higher than we should. It's a tough setup, but I think with a little effort, you can kind of figure it out, right? So this is describing that whole efficiency problem, right? It's not going to kill your audit. It's just going to make you have to do a lot more work, right? Everything's cool in reality, that's what's being described here. We say it's not. So we're going to end up having to, we falsely reject, we're under relying, we're assessing control risk too high. So that's what we're doing. That makes sense. It's a good question. It's a tough setup though. Let's see, about 11. Same type deal with 11, just putting it into words. It's a good question. And 12 is a good question too, but pretty straightforward. Any of these y'all want to look at besides what we did? All right, so we went through all that, and then we're like, okay, now we got to do variable sampling. But the good thing is all the concepts we just talked about pretty much tie in here too. It's just now we're sampling dollar figures to see is the value appropriate. We're determining we're looking for misstatements, right? So we're sampling we've got our sample and we're looking for misstated things that have found their way into the financial statements, and then we're projecting that estimate out to see if we're okay with the final balance, right? So that's the purpose of variable sampling. So same general idea as the attribute sampling. We said tolerable misstatement. I'm sorry, we say tolerable misstatement here instead of tolerable deviation range. Just a different wording to describe really the same thing, right? Because we got a different thing going on. Tested controls, we have controls deviating from what they should. Here we've got a misstatement. So it's not tolerable deviation rate anymore, it's tolerable misstatement. We'll have a projected misstatement that will compare to the tolerable misstatement. Same ideas, just different words. So there's no problem. One, the other, just look out for the different wording. They give us a handful of different sampling techniques that all the test prep companies cover this. So I guess it's worth adding to your little memory bank. Probability proportional to size tends to be the one that's highlighted the most. It gets its own section here, but we can quickly mention the others. So we can, as we're trying to kind of put numbers to these things, we can use difference estimation, where we're finding essentially the total amount off as a ratio to the total samples. It's all pretty logical stuff. They stick a name with it. Audit value minus the book value. What did we find in our audit versus what do they have in the book? In other words, how different are we? What amount off are we as a percentage of the amount sampled? Pretty logical way to do it, right? So that's difference estimation. Ratio estimation is taking the audit, the audit value of the sample. You looked at the sample and you think it should be this value, and then do that as a ratio to the value they say it should be, and extend that to the population. And then mean per unit, total audit value of the sample as a ratio to the total unit sample to get a value per item. I don't know how important these terms are, but there they are to look at, in case you need them. I don't know. I have a starred note at the bottom. It's unlikely they'll have a CPA exam question where you have to calculate sample sizes. They used to have sections where we did sample size calculations for all these 4 things here. It's horrible. Really what you need to know is the concepts of what will increase or decrease your sample size. We already talked about all that. So I think we're fine with that. But yeah, I have my notes from last year, and I have a problem where we did difference estimation, ratio estimation, and mean per unit estimation to get a new audit value ultimately what we think the population audit value should be based on what we found in our sample, right? Because that's what we're doing. We're sampling a small amount and we're finding, okay, in this sample of $50,000 worth, we found that, or I'm sorry, in this sample, we found that we're $50,000 off. We sampled 200 items. All right, that's $250 off per item sample. So let's apply that $250 off to every item in the population to get a new number. That's difference estimation. Ratio estimation is, you know, our, I say this sample should have a $300,000 value. They say it should have a $200,000 value. And I divide and get a 1.2 factor, and I apply that to the entire $5 million population to restate it as I think the population should be 6 million. And then I see if I'm okay with that difference, right? But yeah, I don't think really knowing the ins and outs of these specific methods is probably that super important. But every test company does mention all of these. So I don't know, use your judgment as far as the CPA exam goes. Probability proportional to size, we got our own section on, so we'll check that out in a minute. I didn't specifically mark any of these for us to go over together. It's more the same. Except this one's really more of a question for the next section. And, you know, they do have their little questions about mean per unit, you know, stratified mean per unit, when it would be better to, you know, I feel like these questions are just a little off the wall. I don't know. I don't think I'm leading y'all down the wrong path on this, but I just don't feel like these sampling techniques are super duper important. But I may be wrong. I've been wrong on this type of thing before. I'm just saying, if I'm studying the CPA exam and I come to this, I'm rolling the dice on it probably, personally. Y'all may feel different, but you'll find no questions about those things in exams in here. No questions on any of this. I don't remember. Yeah, we'll just say no on any of it. So don't worry about it. Fine value, one less thing. All right. Let me unhighlight this one because since it does have its own section, we will spend a minute on it. Probability proportional to size. For some reason, they put a little more importance on this. Sometimes this is called dollar unit sampling. So instead of sampling individual items, they attach significance to an individual dollar. And whatever dollar is chosen, we sample whatever that dollar is attached to. That's the probability proportional to size sampling. And I guess the cool advantage of this is it automatically gives you a better chance of selecting those more material items, because those larger, you know, the population is an individual dollar, and you have a more likely chance of hitting those big dollar items because, you know, the more dollar item is, the more chance it has to get chosen because there's more of them there, right? But that's about it, really. So yeah, we won't really worry about that so much in this class. Use your judgment when it comes to CPA exam, as far as how much importance you want to put on it. Becker,
I can look it up.
you haven't looked yet. Okay. Trying to think. I can't remember. I don't think they do a whole lot with it. And like I said, they seem to be decreasing their emphasis on it from year to year. All right, so we'll breeze on through that one too. In the questions, last year when we did these, there was a question number 5 that had a calculation on it, and it's gone now. So they're really putting less emphasis on this stuff. All right, week 9 notes. We got all this IT stuff, which we hit way harder in BEC. But
You have to go through DEC.
yeah, if you've gone through BEC material, you're good to go on this. This is all covered in way more depth in BEC, so they just hit a little bit of this in audit. So here's kind of the high points. And if you remember with BEC, those who have taken it, all the test prep companies differ on what they emphasize is important. So it's kind of hard to study for the IT stuff. But there are some hot spots, and that is what they kind of tend to have hit on this. So we're in the auditing arena of all this IT stuff, right? So the disadvantages of an IT environment that we're trying to audit is that we kind of lose the segregation of duties, right? Things just kind of happen all at once. And we kind of have trouble with the audit trail. I think we've talked about at least the audit trail thing before in here, but I think we may have also mentioned the whole segregation of duties thing. So those can be disadvantages from an auditing standpoint. Advantages is computer processing. It does the same thing every time, right? It's uniform. If it's done right the first one time, an identical transaction will also be correctly processed. So that is an advantage to us as auditors on an IT environment, right? Segregation of duties from the IT standpoint, though, is, and this was a big hot spot in BEC, is we want to kind of keep really all 5 of these segregated. But this tends to be where your questions come from for the most part, these 3. So you don't want the same person who designs the system to be the person who runs the system. That gives them a whole heck of a lot of control and a whole lot of opportunity to just do whatever they want, right? So if you can kind of segregate that out, you got an analyst who designs it, you got a programmer who writes the code and kind of carries out that design, and then you got an operator who runs it. That's good segregation of duties there. If you can keep those things segregated, that's a good thing. Keep someone from having too much control to do whatever they want. And then these other 2 don't tend to be as heavily tested on. Librarian, who keeps tracks of the programs and files and verifies access and limits it to the people who needs to be limited to. It'd be good to have a separate person kind of being the gatekeeper there on that. Security protects things, safeguards the system. Yeah, like those first 3 are the big ones. There can be controls, internal controls built into the systems. There can be various checks and diagnostics that can run. Parity check and echo check, these are terms that we ran across in BEC, right? Parity check is related to the different transmissions of data between different hardware components. A bit is added to each character so that the loss of any portion of the data might be detected. Echo check is related to the transmission of data over phone lines. The signal that was sent was in fact received. So there are built-in controls to kind of check in on all these things. I don't know that those specific definitions are things you just need to take note of or not, but those terms do show up a lot. So I don't know. Application controls are related to the specific processing applications. That's just a broad term. Control totals. This is something that showed up a lot in BC. Batch totals, hash totals. Batch totals are totals that mean something. The days cash withdrawals at the ATM. So a batch total will be a total that you can compare to all the detail to make sure everything kind of matches up. Hash totals are same, they're totals, but then in and of themselves may not have a meaningful interpretation, but you can still add all these up to a total to make sure it matches up to the individual components, like all the employee social security numbers added together, each time would, kind of make sure that no employees were dropped from the payroll application. If that hash total was off, that would catch something like that. There are logic checks, limit tests that test all totals are within a predetermined range, validity checks, missing data checks, check digits. These are some of the things that our text highlighted as important. The questions with our 1 minute that we have left were quite obvious and easy to reason through. Which of the following passwords would be most difficult to crack? We know passwords, right? Which of the following procedures would we include in a disaster recovery plan? We can reason through that. Which of the following documentation types would an auditor most likely utilize in obtaining an understanding of internal control? We've talked about that already. A flow chart that shows the makeup of the system would be a good way for us to get an understanding of internal control. Which of the following is a general control that would assist an entity whose system analyst left the entity in the middle of a project? Why not systems documentations? It's hard to study for the IT stuff, in my opinion, but it's easy to reason through them, in my opinion, too. 5's a good one, though. That's the basic segregation of duties that we talked about. Systems program designs systems for computerized applications, and maintains output controls. That would be a deficiency. We don't want the programmer designing and maintaining, right? So yeah, those are there for you to run through. It's just kind of hard to talk about all the things that could possibly show up. Just kind of get a general basic understanding and reason through questions as they come up, right? Reading through this stuff the first time, I found as I read through it and I'm taking my notes, I'm like, this is a lot and this is too much. But then when I go back and look at my notes, I'm like, oh, that wasn't that much at all. I don't know. That's just kind of my feeling on this stuff. It just seems a little overwhelming on the first read through. I don't know why. And then going back through, it's just like, that's it. Okay, I got it. So it's fairly easy stuff. You just have to kind of not let yourself get overwhelmed with it and kind of get organized, just like anything, just kind of get organized. We're halfway done as far as the tests go, but we're well past halfway done, as you know, as far as knocking the semester out, right? I feel like the hardest material is well behind us as far as covering it. Of course, you got to keep it fresh in your mind for the future exams, but the new content is easier to me, I feel like, all this reporting stuff. And then we'll start getting into reviews and compilations. It's just kind of like, here's a review, here's what it is, nothing too deep or anything. So it's kind of easy. I always like the report stuff because I find it to be kind of easy to deal with. You don't have to rack your brain out thinking about, okay, inherent risk, control risk, detection risk, inverse, or none of that. It's just kind of remembering stuff. My advice to you on reports is they give you a lot of sample reports. Read those, especially the unmodified report. Read it closely because it has all kinds of good content. I remember so many CPA exam questions I was able to answer just from having memorized the unmodified audit report. It was an unqualified report back in my day, but we were required to remember that word for word and write it down word for word in our class. Proved to be super helpful. So in our first section here, we have introduction to audit reports, which really gives us the information about the unmodified report. A lot of your test questions will just be what section of the report. All right, here's what I don't like. So this is brand new standards. They've changed the audit report. Y'all probably learned it differently in undergrad even. Maybe not. Do you remember? You don't remember. In one ear, out the other. It's gone, right? Okay, this is a new change. Last year when we did this class, the report was different. This year it's changed. Where was I going with that? Oh, the thing that's frustrating about that to me is CPA Excel is in the middle of transitioning that, so they don't have very many practice questions for us yet. What they did is threw out all the old ones and they haven't replaced them. So, I don't know how close attention you pay to that spreadsheet I have where I listed how many questions were in each section. A lot of these sections I had listed like 7 or 8 because that's what they were last year. And then some of them had 0 and some of them had 1 or 2. So not as many practice questions for us, unfortunately. So I should say a lot of those questions are easy. They are things like, what part, what section of the audit report does this appear in? And these are great. I love those questions. What section of the report does this appear in? It's a typical question, and I love it. And sometimes it's like, where in the audit report does this section happen? That kind of thing. Well, it's after this, but before this section. Real simple type questions. So getting a good feel for the audit report is super important. So that's where they begin with us. They tell us about the unmodified, the clean audit report and what all's in it. And be sure to know that. Now, the opinion is first. That's a new thing. The opinion has never been first. They just changed that. It used to be last. This is a good change. I don't know why they didn't think to do this before, but that's where they just start the thing out and say, we have audited the financial statements of whatever company as of this date. That's the beginning, and it's longer than that. And again, it's not a bad idea to remember these things. We have audited the financial statements of whatever company, which comprise the balance sheets as of December 31st, 2021 and 2020, and the related statements of income, changes in stockholders' equity and cash flows for the years then ended, and the related notes to the financial statements. I mean, there's not really any big takeaway from that sentence. It's just saying we have audited this, and these are the financial statements we audited, right? And then sentence number 2 is, in our opinion, the accompanying financial statements present fairly in all material respects the financial position of whatever company as of December 31st, 2021 and 2020, and the results of operations and its cash flows for the years then ended in accordance with accounting principles generally accepted in the United States. Those are the 2 sentences in the opinion. So it's just, we audited this. This is our opinion. That's pretty much it, right? So that's a brand new thing. They never had that first before. I forgot when that standard took effect. I think it was 2021, maybe. I don't know. I guess it was. So the opinion is first. Then their second section is basis for opinion. And there's some good content here for us to know that we hopefully already know. We have conducted our audits in accordance with auditing standards generally accepted in the United States, GAS, right? They even have that in parentheses. And then it says our responsibilities under those standards are further described in the auditor's responsibilities for the audit of the financial statements section. Okay. We are required to be independent of the company and meet other ethical responsibilities in accordance with relevant requirements. We believe that the audit evidence we have obtained is sufficient and appropriate. There's that little buzzword again, sufficient, appropriate audit evidence. Sufficient and appropriate to provide a basis for our opinion. So basis for opinion has those 4 sentences. Talking about gas, talking about independence, talking about having the evidence that's sufficient and appropriate to give the opinion. So that describes the basis for the opinion. There'll be some slight changes to that section when you have a qualified or an adverse opinion or something like that. In this one, it says our evidence is sufficient and appropriate to provide the basis for our opinion. We might have a scope limitation in a later section, and we'll have to alter that language. All right. So then we get into responsibilities of management, things we've talked about in here. Here it all is in the audit report, so everybody will understand, right? Management is responsible for the preparation and fair presentation of the financial statements in accordance with accounting principles generally accepted in the United States, and for the design, implementation, and maintenance of internal control relevant to the preparation and fair presentation of financial statements that are free from material misstatement, whether due to error or fraud. Management is responsible for these things. We know this. That's part of the report, right? The rest of that section says, in preparing the financial statements, management is required to evaluate whether there are conditions or events considered in the aggregate that raise substantial doubt about their ability to continue as a going concern for whatever time period. Okay, so there is management's responsibility section says management has to prepare the financial statements. They have to take responsibility for the presentation of the financial statements, the design of internal control, implementation and all that of internal control, and their responsibility to evaluate their ability to continue as a going concern. Things we've learned about early in the semester, right? It is spelled out here on the audit report, so there'll be no misunderstanding. Then we got a huge little section about the auditor's responsibilities. Lots of detail, lots of good stuff to know. Our objectives as the auditor are to obtain reasonable assurance, important word, right? About whether the financial statements as a whole are free from material misstatement, whether due to fraud or error, and to issue an auditor's report that includes our opinion. And then they go into some detail about what reasonable assurance is. Reasonable assurance, it says, is a high level of assurance, but is not absolute assurance, and therefore is not a guarantee that the audit conducted in accordance with GAS will always detect a material misstatement when it exists. The risk of not detecting a material misstatement resulting from fraud is higher than one resulting from error, as fraud may involve collusion, forgery, intentional omissions, misrepresentations, or the override of internal control. This is all kind of a recap of things we've talked about this semester, right? The statements are considered material if individually or in the aggregate, they could reasonably be expected to influence the economic decisions of users made on the basis of these financial statements. So there's a nice little definition of materiality, right? And then it gives a little bullet point list of things that says in performing an audit in accordance with GAS, and they list a bunch of things. We exercise professional judgment and maintain professional skepticism. There's that word again throughout the audit. We identify and assess the risks of material misstatements of the financial statements, whether due to fraud or error, and design and perform audit procedures responsive to those risks. Such procedures include examining on a test basis evidence regarding the amounts and disclosures in the financial statements. Just a nice recap of all the things we've kind of talked about. We obtain an understanding of internal control relevant to the audit in order to design audit procedures that are appropriate in the circumstances. Okay, that's a nice recap of that discussion we had on getting an understanding of internal control, assessing risk of control risk, high and low, all that. But not for the purpose of expressing an opinion on the effectiveness of internal control. Accordingly, no such opinion is expressed. So that's a nice summary of what we are doing with internal controls, getting an understanding so we can plan the rest of the audit, right? Figure out what our substantive tests are going to be. We evaluate the appropriateness of accounting policies used and the reasonableness of significant accounting estimates made by management, as well as evaluate the overall presentation of the financial statements. And then finally, we conclude whether in our judgment there are conditions or events that raise substantial doubt about the ability to continue as a going concern. And then they wrap it up saying we are required to communicate with those charged with governance regarding, among other matters, the planned scope and timing of the audit, significant audit findings, and certain internal control related matters that we identified during the audit. So you can see why that report is so important to get a good feel for. So much good information there that can give you a nice little overview understanding of the audit process and what all's going on, right? So that's the unmodified audit report. So read over that several times as you're studying. It's pretty important. And then you got your signature. You didn't used to have to do this, but now you have to list your city and state, the auditor city and state. And then finally your date, which we talked a lot about how to date that thing. So that's the unmodified report. Now, this whole section of our book is called Introduction to Audit Reports. So they tell us alternatives to this unmodified report. And these are the next several chapters of our book. So we don't really have to talk about all this. We're going to hit it one by one anyway. So yeah. But then they wrap the section up by talking about, most of our reports will be, we audited the financial statements for the years ended December 31st, 2021 and 2020. We've got comparative financial statements. So they wrap this section up with a few comments about comparative statements, the audit report covering multiple years. So the type of opinion doesn't have to be the same for each period. If the prior period statements were audited by some other auditor whose report is not issued, we would add an other matter paragraph, and we're about to talk a lot about other matter paragraphs. But we would have that stating that they were audited by some other auditor, what that opinion was, the nature of any emphasis of matter paragraphs, and its date. So we'll just give that information as part of our report in an other matter paragraph if someone else audited it, right? If their report's not issued. If the report is reissued, then the predecessor auditor has to do a few things. Get a rep letter from us, the successor auditor, regarding items that might affect their report. That seems a little unusual, right? That, usually it's us having to do, it's like, okay, if their report's reissued, we're going to have to do all of this. Well, here, if the predecessor's report is reissued, then the predecessor is going to have to do a little bit of work. But reissuing that audit report, they're not going to be able to refer at all to the new auditor. That's not what they will do. But more on other paragraphs later, or other matter paragraphs later. But here's another bullet point about that. If the prior period statements were not an audit, but they were a compilation or a review or not audited at all, that would be another other matter paragraph indicating that. And we'll talk about reviews and compilations in like week 12 material. After spring break, mind you. So ready for spring break. How about y'all? For sure. Okay, so that is our introductory section. So let me unhighlight these just so I can keep up with where I'm at. Obviously, as always, all already highlighted as the right answer in your files on your Canvas thing. Okay. So a lot of these are very straightforward. And as always, I'm always happy to go over any of them, but I highlighted number 2 to look at. Number 2 says, for an entity's financial statements to be presented fairly in conformity with GAAP, the principles selected should, A says it should be applied on a basis consistent with those followed in the prior years. That's not necessarily true. You know, what if the basis in the prior year was not the way it should have been done, right? So you can't just automatically say, yeah, it works. I mean, and you know, things can change and it's okay to make changes from year to year if you can justify it too. So A doesn't completely work. B says it should be approved by the Auditing Standards Board or the appropriate industry subcommittee. Now, I feel like based on some of the answers I've seen on a question or two in this class, I feel like some in here would have answered that. So I say that to say, be sure to get a good grasp on auditing versus accounting, you know, the auditing standards versus the accounting standards. Auditing Standards Board is going to be involved with auditing standards, right? This question says for the entity's financial statements to be in conformity with GAAP, the principles selected have nothing to do with what the Auditing Standards Board does, right? The Auditing Standards Board is going to have standards about how to audit those GAAP statements, right? So ASB is not the standard setter for GAAP. So B doesn't work. C says it should reflect transactions in a manner that presents the financial statements within a range of acceptable limits. That's some weird wording, but it's true, right? Yeah, why wouldn't it be? Transactions are reflected within a acceptable range of limits. I guess that's a way of saying within, you know, not outside of materiality levels, right? Odd wording, but C is correct. D says it should match principles used by most of the other entities. What if most of the other entities are, you know, you can't just say that, right? What if they're doing it wrong? Or what if your industry is a little different and you justify it for some reason to do it differently, right? You can justify a departure from GAAP if GAAP would be misleading. That's a rule, right? So 2 is interesting because A and D, you could kind of go back and forth and say, yeah, what if this, what if that, right? But they're also going to say, yeah, but what if this? You know, it's got to be completely right. Otherwise, you know, the right answer is never one you can argue with. You can't argue with C, right? I thought that was an interesting question. The others I thought were very straightforward, but we can always discuss any of them. Okay. Very well. You know, number 1, you know, these are typical type questions. So it's definitely always good to pay close attention to any of these. 1 says if an auditor is satisfied that there is only a remote likelihood of a loss resulting from the resolution of a matter involving an uncertainty, the auditor should express what? Remote, satisfied, that all points to everything's fine, right? The financial statements are presenting fairly. You know, if you draw on your financial accounting knowledge from intermediate or whatever, things that are remote are usually not even, you know, if it's a contingent loss that's remote, you don't even have to account for it, right? So this is all unmodified. You definitely wouldn't qualify it. You don't need an emphasis of matter paragraph or something like that. Okay. Questions on this section, comments, anything? Okay, so This next section, kind of a weird spot for it. I think they should have put that somewhere else in the content. This is new. This is a new item that's not really been around. But okay, yeah, you're right. I was thinking ahead to some other content. All right, so this is a new item. This was not part of the book last year. This was not part of the standards until recently. So this is kind of an oddball thing that you may not have seen before. Reporting on key audit matters. So this is a thing that you can be engaged to do. This is not a thing that you just do. You know, this is a thing you would do if the client says, we want this to be part of the engagement. So this guidance applies only when the auditor has been engaged to communicate key audit matters. If they have not specifically been engaged to do so, we're not required to identify and report any of these things. Now, what is a key audit matter? These are matters that were significant in the audit. So, you know, we communicate these things to those charged with governance. And if we're engaged to report, you know, actually report on key audit matters, that's where we'd start selecting items for the most significant of those. And these can be things that you really don't want out there as a company, you know, things like high risks of misstatement areas of high risk, right? Things that challenge the auditor to obtain appropriate evidence, areas that involve a whole lot of judgment on the management's part, complex auditor judgment areas, weird transactions, weird things going on with the IT system, revisions to the risk assessment by the auditor. Not good things. So we got clients engaging the auditor to report these not good things. Why in the world would they do that? They would do that to kind of give better transparency. I mean, if you're reading somebody's audit report and you see all of that, you kind of trust them a little more, right? I mean, they are being very upfront and transparent about, here's our financial statements. They were audited, clean audit opinion. These were the riskiest areas that the auditor found. Why not, right? It's like, hey, there's going to be a spot on there that was really a whole bunch of estimations, and we want you to know that. And this was a really high risk area, and we want you to know that. So it's just better transparency. I like it. You know, at first you're like, why in the world would anybody want this information out there? But it's for that reason. So if the auditor's doing this, they would just add a little key audit matters section to the report. There's no specification where you stick it, but usually it'd be probably after the basis for opinion section. And then the report will just describe each key audit matter, reference any disclose yours, not hers. Explain why it was, you know, just kind of talk about it. Pretty straightforward. Here's a few little tidbits that are good for test questions. They love testing things like this. So this key audit matters section of the report, you would not include any key audit matters in the report that caused a qualified opinion or caused substantial doubt about going concern, because you'll highlight those things elsewhere. Makes sense, right? If there are no key audit matters to be communicated, again, you've been engaged to report on this. So if there's nothing to communicate, you do state that. It's like, hey, we're engaged to do this. No problems. We're cool, right? So there'd be a specific statement in the, again, you'd have a key audit matter section of the report. New area, brand new. Pretty straightforward. They have some questions for us, which I was surprised to see, honestly, with it being such a new section. Very straightforward. Two, I thought kind of added some new information. Just got cut off a bit, didn't they? Fix that. Number 2 says, which of the following statements is correct when the auditor has been engaged to communicate key audit matters in connection with an audit of the entity's financial statements? So A says the auditor should omit the key audit matters section of the auditor's report when the auditor determines that there are no key audit matters to be communicated. So we just said that's not true, right? You're engaged to report it, so you report any or report that there were none. It's a little unusual for us as auditors to do something like that. So that's worth kind of making a special note of. B says we should avoid using standardized language in commenting on key audit matters in the auditor's report. That's the correct answer. When you see the word using standardized language, it's usually a bad thing. Standardized, in this case, I think they're kind of making the point, or kind of making 2 points. You should tailor it to the specific engagement, and everyday language is a good thing. We want this to be readable and understandable. You don't want all this technical, nasty technical jargon that nobody understands. That's the other point I think they're making here. You want tailored to the engagement, and maybe even more important, throw all that weird technical jargon out that's stiff and nobody understands. Nobody likes that. The AICPA doesn't like it. The SEC doesn't like it. We want readers of the financial statements to be able to read and understand. So that's kind of the point they're making with this. So that's the right answer. And that adds kind of some new information for us, I thought. But the wrong answers kind of drive some points home too, right? A, we already read about that. C says when expressing a qualified opinion on the financial statements, the reason for the qualification should also be included among the identified key audit matters. So we just said that we don't even have that any key audit matters that led to a qualified opinion even in there, because we'll deal with that in the wording for the why we qualified the opinion, right? Same with D when we're expressing an adverse opinion. Yeah, so 2 is really good. The others were fine, just kind of straightforward and not as interesting to talk about. Questions on that section? Nothing. Now let's look at one. There's a couple of little interesting things with one as well. It's worth mentioning anyway. Which of the following statements is correct? A says a key audit matter section should be included in the auditor's report on the financial statements for every non-issuer. And that's not true. It's just if they're engaged to, right? It's a separate engagement. So no, it's not a standard. Everybody gets this. B says when engaged to communicate key audit matters, the auditor should report as a key audit matter every issue that involves significant auditor attention. We know from taking tests that that's not going to be right? That'd be every makes that wrong, right? So no, because of that. C says when engaged to communicate key audit matters, the auditor should report as a key audit matter those issues that involve significant auditor attention. Okay, we're good so far. And that the auditor identified as having the most significance to the audit. That's exactly right, right? That's exactly what we're doing. Ooh. Yes, it is. Yeah. Yeah, this is not an old CPA question. I don't think they've probably never even asked a CPA question on this yet. It's so new, but by the time y'all take audit, this will be on there. It's on there now. Yeah. And then this one's again got the, so you can kind of see why each of these is wrong, right? All right. Okay. Good deal. Next section. PCAOB on audit reports. I always love the PCAOB sections because it's like, okay, let me skim over that and see if there's any quick differences and move along, right? The takeaway from this section is this right here. Everything else is just kind of like, whatever. And this is no longer a difference. I made a note to myself to get rid of that. It used to be. So the PCAOB has kind of already been doing the opinion at the beginning. We just adopted that as, or I say we, the AICPA just adopted that. So that's not a difference anymore. The key takeaway from this, though, is this right here. On a PCAOB audit, we must report what's called critical audit matters. And this is any matter communicated to the audit committee, especially involving challenging, subjective, or complex auditor judgment. Kind of like the key audit matter thing we just talked about, right? Except this is required for a PCAOB audit. And the difference here is this would be done for really anything you could communicate to the audit committee along those lines. And it'd be done for an unqualified or qualified opinion. It would not be done for an adverse opinion or disclaimer because we don't want to take away the focus, right? The reason they got an adverse opinion or the reason they got a disclaimer, we don't want to bury that in a bunch of other stuff. We just wanted that to be the, hey, this was a big problem and it caused this. There you go, right? So critical audit matters are not reported if the opinion is an adverse one or if you just disclaim the opinion. So that will only show up for an unmodified or qualified opinion. So there you go. So that's your takeaway. Number 3 in this one, I thought was kind of similar to number 3 in the one we just did because it's kind of the same topic, right? Under PCAOB auditing standards, every audit report must include a section on critical audit matters except for, and we just said it, but you know, here is an audit report having an unqualified with an explanatory paragraph, qualified for scope limitations. So we said unqualified or qualified's fine. Disclaimer, don't, right? Adverse, don't. That's pretty easy. Moving on. Audits of group financial statements. Doesn't really immediately, you know, what is a group financial statement? That doesn't automatically click, right? So what we're talking about here is financial statements that include all that wonderful stuff you're doing on Monday nights, consolidations and mess, right? Oh, trying to forget it, huh? So that kind of thing in a way. Financial statement information, more than one component, combined financial statements, aggregating financial information of components that are under common control, all that wonderful stuff. So a component auditor is one who might do some of the audit work on one of those components. You know, you got all these different, you know, components of a big company, and that component may have a different auditor. It may be an auditor that's part of your firm or part of some firm in your network or just some other random firm that has nothing to do with you. So this is a component of the larger piece of the deal, right? It's a smaller piece of the big thing you're auditing. So we are the big group engagement team. So what do we have to do when a smaller component's been audited by someone else? We need to do obvious things. We need to get an understanding about that auditor, particularly their independence and their competence. So we would definitely want to do that. And then we need to look at the component itself to kind of get an idea of how material that component is to the big picture. And then we would, let's see where I stuck in the notes. I had a note. More on that in a second. I thought I had something in the notes about it, but I guess I don't. I'll just mention it here in a minute. But these are kind of obvious things here, but definitely worth noting. So we want an understanding about independence and competence of the person who audited it, or the group, or whoever audited it. We want to get an idea of the materiality of what we're dealing with here. If the work to be performed by us is based on the expectation that the overall group-wide controls are operating effectively, we should test those controls. Obvious stuff. And we want to do further audit procedures on the wonderful consolidation process that y'all are probably learning about Monday nights right now. Yes, no, not really. Consolidations. Yeah. So you want to do procedures on the process of those consolidated, how they're consolidating everything. Make sure all the companies have been, or components have been included. Yeah, so that kind of thing. So kind of obvious things that we would definitely want to do. If it's a significant component, then we would want to go so far as to review the component auditor's documentation. I don't have it in the notes here, but if it was a not significant component, because we looked at the materiality as part of this right here, right? So if we find it to be significant, we would want to review the audit documentation. If it's insignificant, we would probably do analytical procedures to make sure everything looks kind of reasonable, right?
That's in relation to materiality and knowledge.
Significance.
Not like the size, if you're doing a group, it wouldn't be 20% ownership. That's not what the
No, yeah, it would be in relation to the financial statements. Is this a material thing? Yeah, it's an idea of dollar materiality. Yeah, which that percent ownership would certainly play into that, because of the the more, like if we own 20% of it, then it kind of gets into all that intermediate 1 or 2, I can't remember, stuff where we're doing like the equity method and all of that. And yeah, so 20% of their income is 20%, all that mess. So yeah, but I guess by nature here we are consolidating, so I guess we have over 50% ownership of any of these. All right, so in the, here's kind of the meat of this section as far as test questions go, I would say. So if the group engagement partner decides to assume responsibility for whatever the component auditor did, then we don't make reference to that component auditor in the report. There's no need to. We're assuming responsibility, so our name's on it. No need to include their name. So yeah, if we're assuming responsibility, wouldn't do that. I don't have this in notes either, but also, if the component auditor is not independent, or if you have really serious concerns about really anything, you wouldn't want to use the work of the auditor at all, or make reference to them in the report either, right? So I guess that's kind of obvious, but I thought I'd mention it. So if you like what you see and you want to take responsibility for it, don't mention them in the report. If you're on the other end of that and you're like, this is junk, you don't use it at all, and you don't mention them either, right? You'll have to do your own stuff. So that's if you are assuming responsibility for their work. If not, right here, then you would reference the component auditor in the report. And the report would say something like, we did not audit the financial statements of whatever component. Those statements were audited by other auditors whose report has been furnished to us, and our opinion as it relates to the amounts included is based solely on the report of the other auditors. So you're kind of dividing responsibility here a little bit. You're taking responsibility for all of this, and then they're taking responsibility for this. It's kind of interesting, right? Okay, that's pretty much it for that. The questions here, there were some good ones worth looking at. Number 2, because I think these questions kind of drive some good points home about referencing the auditor or not. 2 says, in a group auditor's report, so the big auditor, the group engagement partner decides not to make reference to the component auditor. All right, that translates to everything's cool. I am comfortable with them. Everything's good, bases are covered, we've done what we need to, we're fine. So we're not making reference to the component auditor. That's what that means. The group auditor could justify this decision if, among other requirements, the group engagement partner did what? A says issued an unmodified opinion on the consolidated financial statements. That's really neither here nor there on this, right? B says learns that the component auditor issued an unmodified opinion. Again, it's not a requirement. It could have been something else, right? What the answer is we could do this if we're satisfied as to the independence and reputation of the component auditor. Now, if we had a component that had some problems, we'd probably do some different things. We probably wouldn't end up having this going on, right? But yeah, this is how we can justify not making reference to the component auditor. We're satisfied of their independence. We're satisfied about their competence. And we've done some other things because this says among other requirements. We can't just do that, right? So that's it for 2. 3 kind of takes you down the same path. The group engagement partner decides not to refer to the component auditor, which means we're cool with everything. Everything's good. After making inquiries about the component auditor's professional reputation and independence, the group engagement partner most likely would do what else? So again, we're taking full responsibility. What would we want to do in addition to checking out their independence and their reputation and stuff? Would we want to throw in an emphasis of matter paragraph? No, that's not what we're doing here. We'll talk about emphasis of matter stuff here in a minute. Would we have an engagement letter that the group auditor assumes no responsibility? No, it's obviously not what we're doing. Do we need written permission from the component auditor to omit the reference? Nope. What we would do is, do a little more work. We can't just stop on checking their independence and competence. We'd want to, particularly if it was material, look at their audit, look at their documentation. Now, if it was immaterial, maybe just crank out some analytical procedures and call it a day, because materiality is materiality. If it's not material, it's not capable of making a difference, and we don't care, right? So that's it. Number 4, the auditor's report contains the following sentences. We did not audit the financial statements of Easy Incorporated, a wholly owned subsidiary, whose statements reflect total assets and revenues constituting 27% and 29% respectively of the related consolidated totals. Those statements were audited by other auditors whose report has been furnished to us, and our opinion, insofar as it relates to the amounts included for Easy Inc., is based solely on the report of other auditors. So that's a nice cutout of what the report might look like. This indicates a division of responsibility. They're responsible for this, we're responsible for the rest. Kind of interesting. Number 5. Which of the following procedures would the group auditor most likely perform after deciding to make reference to a component auditor who audited a subsidiary? Would we review the audit documentation and the audit programs of the component auditor? We wouldn't have to do that. You know, we have division of responsibility here, so we don't have to go so far as to do all of that, right? That's what we would do if we were not referring to, you know, referencing them, and it was material we'd want to do some additional work, right? Would we visit the other CPA and discuss stuff? No, we don't have to go that far. Would we make inquiries? That's something we'll run and do as a minimum right there. And honestly, that would never be wrong, right? So you can answer that and move along, right? All right, questions, comments? A little bit of an oddball section there. That concludes our week 9 material.